Oh, hello everyone and welcome to Fun with Fitzy. Today's video is Chapter 6, Video 6, and we're still looking at the different inventory valuation methods, and we're going to look at the average cost method here. So what is average cost? Well, the average cost method of inventory valuation assumes that the goods available for sale are homogeneous. That means similar in cost. And the allocation of the cost of goods available for sale is made on the basis of the weighted average unit cost incurred. Now be very careful here. We're talking about the weighted average, not just a regular average. So there's a specific method that we need to follow here to get the weighted average. The weighted average unit cost is then applied to the units sold to determine the cost of goods sold and to the units on hand to determine the ending inventory. So let's look at a mini example here. So the allocation of cost of goods available for sale in average cost method is made on the basis of the weighted average. So if you had a cost of goods available for sale, and I'm going to show you this in our table that we did, the Axeman shoe example like we did for FiFO, we'll do it again here. But if your cost of goods available for sale was $12,000 and there were 1,000 units, then you would divide that 12,000 by the 1,000 to get an average cost of $12. And then you would apply this to the number you have left to get your ending inventory and apply this to the number you sold to get your cost of goods sold. So you just have to be really careful that you're taking the number of units divided by the goods, or the goods available for sale divided by the number of units available, not the number of purchases divided by the average price you paid for them there. Again, the average cost method assumes that goods available for sale are homogeneous. And what we mean by that are the $12 average cost, the weighted average that we got here, is going to be applied to what we had left. If we had 450 units left, we would multiply that by 12 to get our ending inventory, in this case, 5,400. And of course, we would also apply that $12 to what we sold. And if we sold, well, it's not saying how much we sold here, but basically it's going to take our 12,000 goods available for sale, subtract what we had left to give us our cost of goods available for sale. We can calculate how many units we sold here. Oh, that's pretty simple actually. We could take 1,000 units that we had minus the 450 that we have left means we had sold 550. So 550 times 12 should equal 6,600. Let's test that out. Perfect. Okay, getting back to our Axeman shoe example here that we used in the last video for FiFO. In this case, we're going to use the same exact example so that you can see that the ending inventory and the cost of goods sold is different depending upon the method you choose. So here again, as a reminder, we had 100 units left and they were $4 each in this particular example. So that was $400 worth of inventory. And then we had purchased on July 1st 50 units at $8, which is another $400. And then on October 1st, we purchased 15 more units and they were $14, which gave us an inventory cost of $700. And on December 1st, we purchased 50 more units and they were $20 each. And so that gives us $1,000 worth of inventory. So our cost of goods available for sale, if you add these all up, are $2,500. Now, with the FIFO method, we assume that the first in were the first out. And if you recall from our example, there were 60 units left. Let's use the same one here. So if we had 60 units left using average cost, if you remember, our formula is our cost of goods available for sale divided by the number of units we have. Sorry, that U doesn't look very good. And so in this case, our cost of goods available for sale was $2,500. And the number of units we have right here is 250. So our average cost per unit is $10. This is much simpler than the FIFO method because it doesn't matter which ones we have to grab. Remember, we had 60 units left here in the FIFO method, so we had to take these 50 and 10 of these to make the 60. But in the weighted average cost method, we're just going to take our $10 and we have 60 left. So our ending inventory is $600. And therefore, if we had 250 on hand and we have 60 left, 250 minus 60 equals 190. Then 190 times $10 is going to be our cost of goods sold because we sold 190. If we had 250, we have 60 left. That means we sold 190. So we had 190 sold. We're going to apply this weighted average cost of $10 that we've calculated here, and it's going to give us $1,900. And this is our cost of goods sold. Remember, we're always trying to calculate our ending inventory and our cost of goods sold. And this number, if you add your ending inventory and your cost of goods sold, should always equal your cost of goods available for sale. So here's a method of which you can check your work. So your ending inventory plus your cost of goods sold should always equal what your cost of goods available for sale were. And in this case, the $2,500 that we had available equals that. So we're good. So under the weighted average, which is what we're looking at, method, our ending inventory was 600 and our cost of goods sold was 1,900. If you recall from the last video, our ending inventory under the FIFO method, so if you recall, the ending inventory was 1140 and our cost of goods sold under FIFO was 1360. Again, if you add those two together, you're still going to get cost of goods available for sale of 2,500. However, using the two different methods, you can see we get different results. So in this case, using weighted average, we got $600 for our ending inventory. However, using the FIFO method, we got 1140, which means our beginning inventory on our balance sheet for next year, because ending inventory is always the same as our beginning inventory, is going to be higher, so our assets on our balance sheet are higher. However, let's think about this on our income statement. Cost of goods sold, as you know, is an expense. So if we have an expense of 1,900 here, using the weighted average, versus 1,360, which one do you think will have a higher net income? Which method? Well, the one that has the higher cost, in this particular case, which is a weighted average, will have a lower net income. But the one with the lower cost of goods sold, the 1,360 here, the FIFO, is going to have the higher net income because that is a lower expense. Okay, so keep that in mind. When it is in a period of rising prices, as we have here, as you see, every time we purchase the inventory, the prices are going up. FIFO is going to net you a higher net income. So as you can see here, accountants can choose the method that is most appropriate for them. However, you can see that you can get into some situations where you can manipulate your net income. So this is where the IFRS and GAAP rules come into play, and you have to make notes about the method you're using on your annual report. So your financial statements have to have notes to go with them, and you need to disclose the method. So this company would have to disclose that they're using the weighted average method for inventory valuation, and this company would have to disclose that they're using FIFO. And you need to be consistent with your methods. You can't change every year. And this is why, because you can net a different net income if you wanted to. Okay? Hope that helped. So by now you should be able to value inventory using the weighted average cost method, and you should be able to calculate ending inventory and cost of goods sold. I would add that you should be able to compare the two methods. compare FIFO and weighted average methods so that you can determine which one would net a higher net income and ending inventory and that sort of thing. So, and keep in mind whether the prices are rising. In the example I used, it was in a period of rising prices, FIFO would have a higher net income because its cost of goods sold was lower. Thanks for watching. Hope that helped, and we'll see you next time.